three big stories. One, the long-awaited Fed meeting happened this week, and so we're going to talk about that. Earnings were right in the middle of it. Amazon, Alphabet, and Apple all reporting this week, and we ended Friday on a jobs report that was way, way better than expected, Derek.
Yeah, the jobs report really was outstanding. The payroll report came in at 517,000 jobs added versus a 190 estimate. They also revised December up, and the unemployment rate dropped to the lowest level in over 50 years to 3.4% when folks were expecting 3.6. So a really strong report. We've said the labor market is strong. Average hourly earnings, though, another bit of good news, moderated a little bit to a 4.4% annual run rate versus 4.6 last month. So clearly the Fed governors are smiling.
Let's sew this all together because they are all interconnected. The jobs report is strong, and that really throws a wrench in the Fed plan, though, Derek, because obviously they're trying to raise rates to slow the growth, and this whole wage price spiral conversation continues to happen. But when you see a jobs report, we're at a 50-year low in unemployment rate. Again, anybody who wants a job can get a job. The ratio of open jobs to those seeking is almost 2 to 1. So that is something that goes right into the Fed speak and the Fed decisions. And let's talk about that because Jerome Powell came out this week and said he's starting to see some disinflationary pressures. But then he did say we could see a couple more rate hikes.
He did. And he, again, talked about data dependency. I think the thing that people took positively from that was people expected him to kind of adopt a Jackson Hole tone, where basically he's scolding the markets for running ahead, for easing financial conditions, which could make the Fed's job tighter. But I think the gist of this is that the timing of a recession has been pushed off. We're clearly not going into a recession when we're seeing jobs reports like this, or the ISM services number, which came in much better than expected on Friday as well. So market positioning at the beginning of the year was clearly offside. The NASDAQ is up 17% year to date.
We talk about recession, the long-awaited recession, and, in our years in this business, we've seen jobless recoveries. But I'm not sure that we've ever had a recession with the lowest unemployment rate in recent memory. So there is a disconnect which could suggest that rates will be higher for longer.
Right. And we've talked often that the playbook has kind of been thrown out. COVID was a unique circumstance. We closed the economy on purpose. As a result, people bought lots of goods while they're shackled in their homes. But now as they're out and the economy reopens, which incidentally China is going to begin doing soon as well, they're shifting more to services. So that services unemployment rate is stubbornly low. You can't find enough qualified people. And that supported the ongoing correction in the goods producing sector.
I don't want to get too far afield, but Danny, you did bring up China and the balloon floating over Montana, the spy balloon. I found that as an interesting story. They had actually stopped planes departing in one of the airports in Montana and had some military jets ready to go.
I got some relatives out there that could probably take care of that.
Exactly. So yeah, they're going to watch it. It may be a spy balloon that is disengaged. We're not sure yet, but they're clearly watching that. And of course, China continues to be a big part of our conversation because the reopening, Derek, will continue to be part of the conversation because their GDP is enormous. And so as they come back online, that's one more issue that the Fed is going to have to work with because they, of course, could be an inflationary pressure as well. So all of this goes into the decision of what should your portfolio look like and what's going to happen. And I've said often that, anytime that everyone is on one side of the table, in other words, saying that we will have a recession in 2023, we're going to have to wait and see how that really works. There's no doubt that all of these pieces are starting to sew themselves together. The Fed earnings, the jobs report. But, these earnings reports, we circled this week in probably December and said the Fed is going to speak and the earnings are going to come out and it's going to be widely awaited. And we saw this week the reporting of the biggest tech companies in the world.
Right. I mean, Apple reported initially people saw it as an earnings miss, which it was the first time since 2016. But they explained it. It was due to some iPhone supply constraints in China and foreign exchange. But generally speaking, Apple, I would not characterize characterize it as a miss, really. I would say it was an inline quarter, better than feared. Another big report also on Thursday was Amazon. Amazon did miss numbers. The stock did trade lower. Their AWS, which is a growth engine for them, missed and is slowing dramatically. We saw that also in Microsoft's report. So Amazon was under pressure on Friday. Starbucks missed. Sales were down 29% in China because essentially China was locked down and people weren't allowed to go out and get coffee to the degree that they do. And then finally, Meta reported a much better than expected quarter. People had been upset about the spending spree that Zuckerberg had gone on in order to fuel the what he believes a metaverse concept. They also announced a $40 billion buyback program, and that stock was up 23% on the day.
Yeah, and so, we think about these big companies for a specific reason. They have an overwhelming weight in the S&P 500 and constitute around 20% of the entire 500 companies come from those top 5 or 6. And so we do pay attention to it, but there certainly has been opportunity throughout the S&P 500 and down cap. We see mid cap and small cap, and especially the triple Qs. NASDAQ really had a nice week.
Yeah, and the interesting thing is if you look at the market with a technical perspective, you see a lot of good signs. You have a golden cross, meaning the 50-day average has crossed over the 200-day average on the S&P. You see much better breadth than we saw in the rallies that we saw earlier this year. And the Fear and Greed Index, which we look at as a measure of optimism or pessimism, is tagged 80 on Friday, which is the highest number we've seen in over a year. So if you hold stocks that were down dramatically last year, Coinbase would be perhaps an example, that stock has doubled year to date. Now might be the time to pare that back if you don't have conviction in it going forward.
And that is something for sure that we go through every position. And we would not only do fundamental analysis, we do technical analysis. If you're not getting that from your current relationship, go ahead and give us a try, because this is what we do with every portfolio and every single holding. I want to move on and talk really about a big story, and that is oil. Of course, we all know that the Strategic Petroleum Reserve had been drawn down, and that had kept oil prices down, which is part of the inflationary argument. But that has ceased, and of course, they're going to have to start filling that up. So all eyes for the next foreseeable future is going to be on energy.
Right, and we know that exploration has started to tick up a little bit, but nowhere near what you'd expect given the current price of oil. We saw that both Chevron and Exxon declared massive dividends, also massive share buybacks. So those companies are doing extremely well. And the important thing on earnings is the energy sector's strength has masked the deterioration of earnings across the S&P. So a lot of this negativity about future growth has been priced in, which is part of the reason why I think people, essentially portfolio managers chose not to find what they didn't want to see. In other words, they didn't want to see the green shoots that were starting to appear, that valuations become more attractive, the odds of a soft landing were increasing, and the Fed was closer to ending their tightening realm than continuing it.
And so, folks, I don't want you to conflate volatility with risk. Volatility is going to be with us for a bit throughout this year, but risk is in a whole different conversation. Go through and get an assessment that we give to every single person that walks through the door, and that can be done through our wealth metric process.